You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. You can find their website at institutionaladvisors.com. Welcome to the show, Bob.
Jim, good to be with you.
Well, another very interesting week on the equity markets.
Oh, yeah. Yeah, it is a huge forces going on out there. We've noted earlier in the year that you had exuberance in the markets that was measurable, and on some of those that continued right into September, you had the percent bears of market letter writers down to 13.3, hadn't been there since 1987. Then on our own proprietary work, one of the models we've got registered upside exhaustion in August and September on the monthly reading. Hadn't had that since early 2000, which was the big tech bubble. So that was the exuberant side. And then we were looking for divergence, where it's showing that fewer and fewer stocks were participating in the party. And that showed up with the Russell, the small cap index, which peaked earlier and decayed earlier. So then you had divergence, which was a warning. Then the next one was the arrival of volatility. And you had the VIX, which measures volatility, did a tremendous jump. It was there. So that was with the turmoil, which we've had. And then we also looked at seasonality for fabulous exuberance. And oftentimes the reversals can come in the fall and sort of have their worst selling parts in October, which we've had. And then maybe a bounce, which we're working on, and then a test of the lows in November. And then you could have a tradable market out into the spring. So that's basically the pattern we're working on here. And that was also, the party was in credit markets as well, with the urge to buy junk became very exciting. And but junk sort of peaked earlier in the year, and that was another divergence. But it got hit fairly hard. And looking at the ETF on it, J&K, went down through the 50-day moving average and through the 200-day. And then last week, the decline was sharp enough to then register what we call a springboard buy pattern. So the junk bond rallied, and it rallied so strong that we now have the inverted springboard on it. So it's a springboard sell now. And the S&P has been, the major stock market has been trading off of that junk bond, and it's been dynamic enough that it gets some pretty good signals. So we think there can be one more little weakness in the equity markets here, and then that perhaps will test the lows, and we can look forward to a market into the spring. The other one that's been fascinating is that the commodities have been generally weak for a number of years, and you've had the commodity bulls who didn't see it coming because they look at reckless central banking, of which this is record stuff. These guys are gambling like you wouldn't believe, and assume that recklessness and ease and accommodation and everything else is going to straight into commodities and gold and silver. Well, that's not working, because you have the public, the broad public, which includes institutions and everybody, corporations, everything. So it's the whole market. And we look at commodities, and one of our long-term indicators, it doesn't trigger too often. It was up there with the big boom in gold and silver that peaked out in 2011. And that was also the high for most commodities as well. And we noted then that there would be likely a bear market for these items, without knowing exactly how long it would last. So you have had weakness in base metals, in grains, and in precious metals. at a time of unbelievably reckless central banking. And this must be very perplexing to the permabulls, but nevertheless it has been happening. And what it is that the public decides what will be speculated in. So we go all the way back to the 1970s, where the speculation was in tangible assets, commodities, and it was also in wages. Wages were soaring, so that drove the CPI up to 14%, and bond yield to 15%. And then that speculation in that group of things, wages, CPI, commodities, blew out in 1980 and crashed very hard. But as that was crashing, that was then liberating the next big event, which was the game in financial assets. And this is where they give credit to Volcker for tightening up and ending inflation. But if you look at the money supply figures year to year to year through that period, there was no contraction in money supply figures. It just kept growing. So the Fed stayed easy through that period, and the action shifted over to stocks and bonds, which it still continues. So this, at some point, the speculation in stocks and bonds, well, maybe this summer it got up enough to really end that game, whereby then you get into a condition that no matter what the policymakers do, no matter what the central bank prints and everything else, that things are not going up, but we're not there yet. So the bonds, again, our advice for investors is this is a pretty wild market to try and trade. Investing, reaching for yield is always a hopeless case. So we would be in 3 to 4 year maturities in good high-grade corporate bonds. You won't get hit on risk, and you won't get hit on term risk. And also, we've always mentioned that for Canadian investors or investors in other countries, you could buy these instruments 3 to 4 year stuff in U.S., and then you get the currency play, which this year has been outstanding. So then we won't trade there. Now, on the long government bonds, they're still buoyant. There's this trade where when the stock and commodity markets do sell off, the long bond rallies, but it's getting a bit pricey in here as well. So, and then we have on the precious metal sector, since earlier in the year when we thought that the U.S. dollar could go up and it needed to get above 81 on the dollar index, and it did that, I think, in July, that if it got through 81, it could make it to 85. And then when it got to 85, we said, hey, it's a bit overbought here, but we're in a period of time where moves can extend, and that would be in the dollar going up, which it did, I think, in almost 87. And then on that one also, through the summer, we'd noted that, and this was the first instruction on it there, Jim, was with wheat, and the grains became very oversold in July, and oversold enough to maybe make a trade. Well, it just sort of paused on the decline, so then grain prices crashed from an oversold condition. So then also that then eventually developed in crude oil, it's been very weak since September. So these are not positive signs. You've got still within the financial system a dread of rising prices and inflation and all that sort of stuff. But when you get basic products prices coming down, producer price indexes, and these commodities, it's not really positive. It's saying that somewhere the global economy is slowing. So
we'll have more from Bob Hoye about where he expects crude prices to go right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to market historian Bob Hoye. Bob, what's going to happen to crude prices?
Now, on the crude oil, we figured in September that it would fail, and there is a seasonal component down into December. So crude could be weaker for a bit yet. Copper, it can have a seasonal low in November. So on some of these, we're getting close to perhaps looking for a rise. And then over in the precious metals department, we've just can't get excited about gold in U.S. dollars when the U.S. dollar is firm. But so then in order to get around that and figure out really what's going on in the industry is that when people are looking at gold in U.S. dollar terms, and this includes the gold bugs and everybody else, is that they're speculating on a sort of a currency play. But if you're an investor and potentially in gold shares, you want to take a look at how is the industry making any money? And the way to tell that is the price of gold outperforming the cost of mining gold? Whereas if you look at just the dollar price of gold, that don't tell you that. In order to look at that, you want to check out the real price. So what we did is take the price of gold daily, and we created a commodity index, our own, that we hoped would be like the Economist All Items Index. And the reason for doing that is that most of the commodity indexes consider that gold is a commodity. So CRB or Jimmy Rogers commodity index, they all got gold in it. But if you want to get gold's real price, you don't want to have the price of gold on top of the divisor and below it as well. So anyways, on a cyclical basis, gold real price has been declining since the party in financial assets took off in March of 2009. So anyway, so it declined and declined and declined, and set what we would think is a cyclical low in June, and it continues to rise. And what this is doing is saying that profitability is coming back into the gold mining business. Like, you know, the big cost is energy, and you got crude oil falling relative to gold. So their costs somewhere in there should start to limit. And so this is the whole thing on analyzing a gold mining company is to look at their costs and the price of gold, and that the gold divided by commodities index is a proxy for that. So here we are now. Since summer, we've been considering that maybe somewhere gold shares would decline into October, and there would be a buying opportunity. And we're not quite ready yet to pull the trigger and begin recommending accumulating gold shares. Maybe in a week or so. So, gosh, we don't know. The only thing we're looking at here is to buy is 3 to 4 year high-grade bonds. But that's the investment world, and those are our choices, and everything looks pretty precarious.
Bob, very interesting. Thanks a lot for chatting with us.
Jim, always good to be with you.
My guest has been market historian Bob Hoye, the chief investment strategist for Institutional Advisors. You can find their website at institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. We're also up on YouTube. You can forward comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.